Hey guys, Freaky Finance here. Today we're going to talk about a REIT, H&R REIT. We've kind of talked about it on the channel before, but we're going to go into a little bit more detail today. One of the themes that we're going to talk about, it kind of came up during AMD when we did the video because things have kind of run up. It's amazing what 3 months can do from April to now July. And there's a lot of outperformance that we were able to take advantage of and fear during that time. And now we're on the other end of, not necessarily at the other end of that, but now it's less obvious that there's fear, obviously, after everything is back to all-time highs, or a lot of things are, that we own. And so one of the things I like to do, it's kind of like the bond video we did where I kind of view bonds as setting up the next lever. That's what I do with REITs as well, and other more defensive companies, usually defensive companies. So REITs are one, and consumer staples are another, and utilities and other stuff like that. And what I do is just kind of oscillate. So I'll start trimming some of the growthier names that have gone up a lot, especially a lot quickly, and I'll slowly move some back into these kind of what I call bond proxies, kind of make some money very steady over time businesses. So less exciting, less glamour, but that's kind of how I treat it. And then when there's fear again, what I do is that's what I can sell to buy the fear. By the AMDs, right? By the Googles, by the Amazons. That's kind of how I treat it. So this is a video kind of like that, because that's where my head's at. And it's also a video because they recently got targeted to be taken out. And that's another thing that's good with great companies, that management's doing what you want them to do with the cards that they had and the properties that they had at a crazy NAV discount for this conglomerate of diversified REIT. And we're not gonna go into all the sectors of REITs, but we are gonna go through probably enough REITs that we'll learn all about the sectors over time. But anyway, H&R REIT still diversified. And I wanted to, before I dive into H&R REIT, this is kind of what I mean when I look at the opportunity set. And that's something when you're jumping industry to industry, you kind of want to see, okay, what industry is currently out of favor? And we're seeing a lot of US branded consumer defensive packaged foods out of favor. So Kraft Heinz, General Mills, right? Near 52-week lows, near 52-week lows, or on 52-week lows. Right? Smucker's finally rallied a little bit after an overreaction from a material impairment, from a poor acquisition. Campbell's Soup, we just started looking at and actually started positioning, and Conagra, which we finally started positioning. So you're seeing a lot of these downward, straight down, totally out of favor, and now we get to go in them and see which one do I want to own and why. And you also have to ask yourself, why am I getting the price that I'm getting? Why is this under pressure? Part of it is tariffs. Part of it is the long-term trend of like the Walmarts of the world having their own private label, which is taking share from these big brands. And a part of it is the viewpoint of nationalism, again, because this more nationalistic world, especially this rate of change in this first year with Trump, a lot of local grocery markets are going to push their local brands or their private labels, right? A lot of these grocery stores are going to push their private labels even harder. And you're going to see a lot of goodwill from these US brands go down, and that's what the market's trying to front run more of. And we have seen sales slow down, but that's been true for probably 4 quarters now. So anyway, it's worth bringing up. It's where I look for opportunity sets. Usually when everything's cheap in industry all at once, or a subsector of an industry, in this case packaged foods, it usually tells me there's an opportunity somewhere in here. So that's kind of how I view things. And again, one of the goals here is to start looking at more defensive names that pay a pretty good dividend, have good balance sheet, stuff like that. So anyway, H&R REIT has an acquisition. We don't know the price. The market moved up about 20% on it, which would still be a crazy NAV discount. This company traded around like $10, under $10 at times, even though the NAV was over $21 in assets. And that's with the write-downs that they've taken as interest rates go up, because REITs have to market their property. But they also have to, as rates go up, the R goes up. They have to usually requires a write down in the actual value of the assets, even if that's not necessarily the true value of the assets. It's one of the fun things about accounting. And then conversely, as rates come back down, they're going to slowly see, or they should see, their assets start going back up. It'll actually make them look less levered. But anyway, that's neither here nor there. It's just kind of an accounting thing. Keep your head. One of the great things about H&R REIT is that they've done everything I would do if I had their cards. So they started 2021. They had a lot of retail, so they had Primaris, which they spun out, but they had a whole lot of retail malls. And then they also had a whole lot of office space. And then they had overexposure to energy. And this was right after COVID, right? So all these things were out of favor. And they made a whole bunch of decisions that I think were extremely prudent. And basically they started decreasing their exposure to retail, decreasing their exposure to office, decreasing their exposure to energy tenants, like the Bow in Calgary, right? Don't get me wrong, they still have some with Hess, but it's lower. And then they've pushed it more into residential, especially in the US residential. It's been a strong growth engine where they performed well. And they've also started pushing industrial more. So you're going to see that as we go through the numbers. This is a spinoff of Primaris, which was another REIT that actually trades at a pretty steep discount, even though sales have come back. And we've actually done a video on Primaris, I think, on the channel before. So they made all these right moves, and this is a great chart just to show the trend, right? You can just see June to March, almost 4 years later exactly. You can just see residential up to 49% of the business, industrial up to 18% of the business, office and retail have gone down materially. And they're still rezoning a lot of office, either into residential or industrial, depending on the location. And this is just another way to show the type of things by fair value, by segment. And you can also see the shape is now a lot more US focused. Here I just kind of wanted to show the NAV, just to, not like my personal take on it. It's $20. So well, the thing's trading at $12. It's still at a steep discount. So if they are, whoever's trying to acquire H&R REIT or a part of H&R REIT, we don't really know, is still getting it at a sick deal. That's a harder thing about this video because the REIT's gone up 20% and now the other REITs haven't. So I want to start looking at that in the competitive set and the competitive lens, and that makes it hard to know because is the market going to be content enough with just a 20% premium, even though the NAV is $20 and this person hasn't really done anything, is just going to walk in and take what I think is a receleration of their business after doing all the hard stuff. But anyway, that's just my opinion. I should say that I do own this one right here. Not a big position, but it's kind of how I slowly add to REITs after fear is no longer present or is obvious. So that's kind of how I treat things. So I've started positioning Granite, Dream, and Northwest Healthcare. So that one's slightly riskier, though it's also very cheap. And I also wanted to show the positions I started in Conagra and Campbell's. Again, these are very small positions. I'm just trying to familiarize myself with it and get, like, I haven't followed Campbell's Soup at all, right? I don't even know all the brands that they own yet in snacks. So I need to start doing work on that. This is a way for me to force myself to look at stuff. So anyway, HR REIT's there. I wanted to show that I do own it. The most important metric for a company that's constantly churning their assets is going to be the same property, net operating income. And you can see that slowly going up. Obviously for a REIT, what I like to look at is the AFFO and the FFO, funds from operations. There's slightly different metrics for REITs than other industries. But those are the two that are most meaningful. Usually the delta is just the maintenance. That's usually the biggest part. And so you always want to make sure your AFFO covers the dividend. And then hopefully enough that they can still slowly pay down debt. REITs are a great instrument, and your RSPs, that's what I use them a lot in, as well as my Lira. So it's a great vehicle tax-wise in Canada. And the balance sheet's been fine for a long time. Here on the latest one, you can see same property income up 4.4%. And here you can see some pretty strong with residential and industrial. And we've seen strength in these two for a while. It is exciting that retail's come back a bit, but it's been a little bit more recent. But we're seeing 4.4% NOI growth year over year, which is pretty strong. Occupancy has been solid. Payout ratio is still very low at 61%, so the dividend's easily covered. The debt's fine. Here's a way to view their $9.2 billion in assets. You can see it's dominated by residential value now. You can see that it's a pretty good split up between retail, office, and industrial. And basically with the NAV discount, even after this potential acquisition that this company's going to acquire on, it's basically only giving the value to industrial and residential and still giving zero, maybe even slightly negative value to office and retail, even after everything they've done. That's what the market's saying. So it's still dirt cheap. They have a lot of long-term leases still. Just worth bringing that up. In terms of the cap structure, it is important to know which, just like a mortgage on a house, say, residential or REITs, you're going to have the mortgages, so that's secured to the asset directly. Then you have senior unsecured debentures. So these are things that are not secured, but they're senior. It's basically a way to, so how the cost of capital is very important for a REIT. It's probably one of the most important things that a lot of people don't understand. And mortgages, when you secure something, basically your rate goes down. Think of how I get charged on my home equity line of credit. Might be, I don't know, prime plus 1 or something. So say 4%, whereas if I borrow on a credit card unsecured by anything, I'm getting charged 20% interest. Basically, when you secure things, collateral, the interest rate that you're going to charge goes down. So usually interest rates lower for mortgage, slightly higher for senior unsecured, and then unsecured, which would be below senior, you'd have a higher interest rate. And this tells me they have a lot of room. If they want to, they could resecure assets to lower down the interest rate if they wanted to. It's not something that they might do, it's just something that's available to them, which isn't available to all REITs. I also like to look at the maturity schedule, especially when rates gone up. So it's still important now. It's not as important as it was as rates have started to come back down. But you need to be aware of the maturity schedule for REIT, especially if there's a lot of debt due at once and the rate's going to reset higher. So say if their WACC is 4%, the weighted average cost of capital, and you know you have a lot of debt coming and it's going to reset at around 6, or that's what you think, right? That WACC is going to be under pressure. That's going to put pressure on the REIT. It's going to put pressure on the dividend that they can pay out. So you need to be aware of this. So this is something that's against H&R REIT, is that they do have a decent amount of debt coming up. However, the delta isn't as bad as it was a year ago when rates were higher in Canada. So that's also something that's interesting here. They also have a lot of assets now in the US versus Canada, so it'll be interesting to see where they decide to borrow. Whether they try to keep it in kind currency, or they start doing, depends what the interest rates they'll get in Canada versus US. But in terms of the tenants, also very important. Sometimes there's concentration risk. This is just the industrial side. You can see a lot of it's industrial. For Canadian Tire, 20%. Which is what we want anyway, because we talked about Canadian Tire before with nationalism in Canada, and that will pick up sales. The market's finally front running that, so I'm not worried about that one. But we do look at them, and obviously Hudson's Bay 2.5%. We have to remember industrial is only 18% of the business, right? So even if so it's really 2.5 times 1.18, right? So slightly different. Here's the actual tenants by everybody, and you can see the biggest one by far is still Hess, which I believe is being acquired. So still a decent amount of energy, but you can see some pretty strong, stable businesses. Giant Eagle, TC Energy, your Canadian Tire again, right? And then the banks, Bell, right? Metro, grocery stores. So very, in my mind, very diversified, aside from maybe Hess. So that's something to keep in the back of your head. It's not huge thing. If oil slams down, maybe they have struggles, right? You need to look at, I would probably look at Hess's balance sheet just to see how they're doing. I did probably 2 years ago, and they're fine. So when oil hasn't moved that much, even though it feels like it. What else can I say? This is probably my favorite page on the quarterly, page 11. They kind of break down each of the types, so residential, industrial, office, and retail. Residential is the growth engine, so it's most important to me, so I like to make sure occupancy is starting to trend up again. The cap rate, you can see it's still high. Basically, what we want to see is a rate of change increase, decel in cap rate. And once rates come back down, they're going to reduce their cap rate, or that should start seeing a reduced cap rate, which should help these investment properties. So you're going to see the increase in value finally again on accounting terms. And you can see the cap rate is higher because it's supposed to reflect the risk. So the market is still thinks office is the boogeyman, even though all I keep hearing on my phone is how everyone's working back to work at the office. But anyway, you're still seeing relatively high cap rates, so if interest rates come down, these REITs will benefit as well. So will the property values. So it de-risks both the cash flow side of it, and it also de-risks in terms of the debt to assets. Because these guys actually got squeezed pretty hard. They had to do some, not just H&R REIT, but all the REITs. They all had to do this. So anyway, I always look at that. So cap rate, I look at the occupancy, and I want to make sure that the same property net operating income is going up slowly over time. Are they making more on their assets each year, on the assets that they have that are comparable? Because there's a lot of churn, they're making a lot of changes, right? They're selling some of these and adding some of these. So you need to take everything holistically. So same property NOI is very important. Almost as important as the FFO and AFFO. Here I just like to see the average rent and how it's kind of resetting year over year for each area to see if they're still able to take price. They should see price takes year over year. And one of the other things, especially when I look at Granite and Dream Industrial, on industrial side, there's still a lot of market spread. We're talking like, well, the AI thinks it's like 40 and 50, but you're talking about these material spreads between what they're currently charging and what the current market rate is. And when these leases come up for renewal, they're able to take that spread, or that's the idea, or at least part of the spread. And so you should see Rent slowly go up over time. It so usually always has, but it depends on the sector and the REIT in the industry. Like apartment REITs have a cap, so you need to be aware of that, right? So you need to, it's a little bit complicated, but you need to know what type of REIT you own and if you actually believe in that market spread that they're talking about. Well, you can see over here pretty solid numbers and pretty stable numbers, which is kind of what you'd expect. So overall, rent's gone from $25.60 on average to $25.81 in the US, and in Canada it's gone from $12.68 to $12.86 per square foot. So and that depends on the property, depends on where it is, depends on a lot of things. So, but the main thing, you just want to make sure that it keeps slogging up. And at the same time, usually what happens, not always, but the REIT usually, the leverage slowly goes down at the same time as the properties, and the debt slowly gets paid off. So you're going to see your cash flow slowly go up and the balance sheet slowly get better. Now REITs have to give off a lot of their return earnings, 95% of it, to us, the investors. So they can't keep a lot of the cash on it, but they will be able to decrease the debt over time. So that's a nice thing as well. Though they can be caught if they make acquisitions or do something at a very bad time, right before like a property values decline, then they can get an over debt, and you'll see a REIT that it's no longer defensive like you thought it was. So you always need to watch the leverage. Here's just some of the following properties that are process of rezoning, because I want to show that. So again, they're to use residential. You can see a lot of these for office, to remove office density, So get the zoning, then start making the changes to convert more properties from office to residential in the GTA area. So that's something that's ongoing. H&R REIT is getting something that I would be doing if I had their assets and their cards. Here's what I kind of look at is, that's why I said WAC 4, is because I'm trying to see what debt is coming due this year, what's it coming due at, and if I think how much are they going to get squeezed when they try to recycle that debt, right? So if this 131 million comes due, right, this year, it's 3.6. Are they able to roll it? What price do they get? Is it 5%, right? And so it's 3.6 to 5. It sucks, but it's not going to be a huge movement on the WAC. It's just going to be some pressure. And that's kind of, we've already seen this pressure happen. We're actually on the back end of this as rates start coming back down. But it depends on the delta between their current interest rate and what they're going to get charged when they try to basically recycle the debt, refinance. And I think REITs are finally probably one of the better areas in terms of a risk-adjusted basis to make some steady cash, and likely get the flip side as rates slowly, at least they're no longer killing you on the way up, as they flatline and slowly go down over time, even with this inflation scare again with tariffs. I asked AI to basically go into a bunch of REITs. Well, I made the AI pick which REITs I wanted to go into, just to find market spreads in rent. And you can see that it flags Boardwalk and Cap REIT, and it talks about how there's a limit on it, and then Industrial REIT, where it thinks in-place rents 28.2% across Canada, right? The market rents exceeded the in-place rents by that much, 28.2%. Here, Granite achieved rental spreads over 10% over expiring rents year over year, right? So this is what they're actually getting year over year, which is nice. And Industrial does have those kind of spreads still. I was kind of surprised that RioCan has, as much as it has, a blended lease spread of 17.5% given the assets. So that's something I might dig through that I wasn't going to dig through, is RioCan at this time. So that's something I'll look at. We've talked about some office before when it was out of favor, or more obviously out of favor. In terms of like the rate of change and why it's kind of like this, whoever's making this acquisition of H&R REIT, I think is very opportunistic. It's because all the hard work's been done. They already had their slowest same property NOI growth last year, which they're comping now and accelerating out of. So they're looking at a business that's accelerating after doing a lot of hard work, right? At a discount, like it was trading at 10, now it's at 12 because of the acquisition potential. But you could see just amazing the NAV value behind these property assets when most of them are now residential. It's still trading like a lot of it's office, a lot of it's retail, and the market's still afraid. It's just crazy to me. And the AFO's fine, the debt's fine. So I just wanted to show that real quick, kind of the metrics that I look at. And then importantly, has management acted as I would be acting, doing things that I would be doing, right? And they are. So everything that they've done makes sense to me. Growth engine, AI correctly points out, is Land Tower, US residential side, right? They had 5.1% same property NOI growth, high occupancy levels above 95% consistently. as of year end 2024, the average in place rent was under $10 a square foot, whereas the market renewal rates are still in the 14 to 15. So as that slowly resets, you just see the higher rent come in. And that's nice. That's a nice position to be in, especially when you're getting such a NAV discount on the whole business, right? It's like if it was priced anything like how land tower is performing, it would be material higher already, right? This should be over 15, no problem, right? And the fact that it's over 12 with someone who's thinking about acquiring it, it's just so opportunistic, in my opinion. But that's fine. That's what the market does, right? It does this. It did it to Walgreens, shot it down. Someone took it out, right? Paramount shot it down. Someone's gonna take it out, right? Good things happen to extremely cheap assets, and so this is another one, a good example of that, I guess, as well. This is just, I wanted to compare it because I was looking at Granite and Dream, especially after H&R REIT just shot up, right? So I wanted to compare the debt, just quick snapshots, right? The debt, the div yield, kind of what I'm getting, and then discount. And obviously the in-place rents are going to be higher for Granite and Dream, just because of the assets are all industrial, which are in high demand still. I did think this was interesting. The recent confirmation of the formal strategic review prompted by the unsolicited third-party acquisition interest serves as an ultimate validation of this undervaluation. I mean, yeah, thanks for coming out, AI. But yeah, that does validate the thesis of how cheap these assets are at H&R REIT. This would just be nice, but I doubt anyone's going to bid all the way back up to the NAV. That would be a dream, but I can't imagine us walking away at $12 when we know the assets are worth 20 and they've done all the hard work already. But I mean, it's still a 20% premium to what it was beforehand, right? We just don't know what the premium will be, and I don't know whether they're selling the full thing. It sounds like they're interested in the entire REIT more than just selling off Canada, the rest of Canada, right? Because that would also be an interesting move for H&R REIT. It would be more in line with what they've done recently, right? They've done a lot of, not necessarily small moves, but very gradual moves, piecemeal. Like, okay, this is spin off the malls, then rezone the office, reduce our exposure to energy in Calgary, right? They've done things gradually, so it could be interesting to see if they're like, you know what, we're just going to focus on the US because we've done well there. That could be something that maybe they're thinking. And then overall, how I kind of look for things, this is kind of more of a screener for me. So like I'm going to look at Morguard, which I don't own yet, Northwest Healthcare, which I just started a token position in, right, to look at it, be like, why am I getting this spread? Especially in this one because it's gone down so much lately. So I want to see, because I think this NAV discount's even worse, but we'll see. And then RioCan, kind of interesting, partially because the AI flagged it. So there's still a lot of decent discounts out there as rates slowly come down in Canada. You're just going to see appreciation in the property value as the AFFO payout ratios finally start getting better instead of worse and under pressure like they have been as the rates went up. So anyway, I'd like to know your thoughts on REITs. A little bit long-winded, but I like to talk about them. If there's any REITs that you're really passionate about, let me know. I like to dig in them. I might look at Allied again. We did a video on that, about office, especially when it was all of them are getting smacked. But yeah, I'd like to know your thoughts, and have a great rest of your week.